If you look at the 3 month to 10 year, which is the more predictive curve according to many Fed regional banks, that's basically telling us a two-pronged story. Number one is at the short end, they're telling us they're waiting for the Fed to begin the easing cycle, right? Historically, when the Fed begins to ease, the short end comes crashing down and the long end goes down a bit, and that's what reslopes the curve into a positive territory. And so we're still waiting for that to happen with that 3 months still above 5%. Now, if you look at the longer end of the curve, the 10 year has come down. The 2 year, as you can see on your screen, has also come down. So we've seen yields come down a bit. And that has been a two-prong attack, which is number one, concerns about the economy, and number two is the reality that inflation has in fact slowed materially from the last couple of years. So that is sort of a double whammy. If we believe that the recession outlook is more intense, I think you should expect to see yields come down across the board, and the expectations for the Fed to do an awful lot more. But remember, the Fed easing cycle is not driven by the calendar year. It's driven by their framework of what they think they need to do to maintain stability in employment or unemployment, and as well as inflation. And they've already told us, as Meester said in that clip, they've told us with the SEP in June, they're going to cut 225 basis points in the next 2.5 years. Now, we've got them doing 3 this year and 3 next year. They're doing 225 through the end of 2026. And if that's the case, that is going to be very stimulative. We think it's going to be very positive for the economy, especially given where some of the areas of weakness are, which are in interest rate sensitive sectors.